3, 2, 1.
All right.
Welcome to the show, everybody.
Welcome to the show.
I always feel like saying welcome to the show, but
Dude, it's weird. It's weird because it feels like it should be live, and it's not, and we're recording, and we're just shooting shit. But
one of these days we might
like
get back to being live. Yeah. We gotta get out of our day jobs.
I like that. I like when it's live.
I do too. What you got for us this? I'm excited about this one. A lot of people have been asking for this show in particular, this topic.
Yeah, the L funds are a big deal. So I put a lot of work into kind of putting this thing together, and what we didn't do is rehearse it, right? Because we talked about how rehearsing is not a
it never
comes across well, right? So kind of bear with us if it gets a little disjointed. Yeah. Right, as we're going through it, but
and this won't be the last time we talk about it.
No, right. I'm just saying, like on this, I'm going to be reading some of these. I have notes for the slides, and I'm going to be reading some of this, and obviously, it's going to be me reading it, and because I've already prepared it, so it's not going to be us just kind of
winging it,
kicking back and winging it. So there's going to be a little bit of winging, a little bit of reading, a little bit of all of it, and hopefully, at the end of the day, it comes out good. Right?
Let's hit it.
All right. So weekly update, 27 September 2020. So magical thinking is not your friend. Ryan Holiday. This is a quote from Ryan Holiday from the Daily Stoic. Ryan Holiday is an author, podcaster, and historian of the Stoics. So think Marcus Aurelius, Seneca, Epictetus, all those guys. So as I'm sitting down writing this presentation on the L funds, his daily email pops into my box, and it's clearly applicable to what we're going to be talking about on the L funds. Okay, so this is going to sound a little harsh, and it's definitely unconventional, but the L funds are based on magical thinking. Surprise, surprise. So we're going to do a deep dive into the concept of the L funds, right? Not what just they are consisted of, right? They're consisted of, we all know the C, S, I, F, and G. But we're going to look at the basis of the L funds and compare that to the basis of active management, which is what we do at Grow My TSP, and see which is real and which is really magical thinking. But before we get to that, we're going to do one chart this week, which is a look at the long-term C fund chart to give us some perspective on what happened this week. And again, it was another very turbulent week. So here's a chart of the past 6 years on the C fund, and it's weekly, right? So I do a weekly chart here instead of the daily because it kind of makes it the perspective a little bit easier to kind of see. I know I talk a lot about the 50-day moving average, the DMA, the daily moving average. If you're looking at a weekly chart, it's the WMA, the weekly moving average, okay? So what I did was I went back and made these lines. The blue line is the 10-week moving average, but it's comparable to the 50-day moving average. So if you were looking at a daily chart, the price would be around the same as the 50-day moving average. But this is a weekly chart, so it's a 10-week moving average. Well, hopefully that makes sense. The red line is it's the 40-week moving average, and it's comparable to the 200-day moving average. Okay? So hopefully that makes sense. If you don't get it here on the podcast, I go into a lot more detail on the regular post that
the weekly update
newsletter. Regular week, that we'll post later this weekend. Earlier than what you're hearing it right now, but I haven't posted it yet. I have written it, but I haven't posted it yet. Okay. So, in the past 6 years, right since 2016. All those blue arrows are pointing to places on the 40-week moving average, which again is comparable to the 200-day moving average. So almost every time the price has corrected down to the 200-day moving average, it has found support there. Okay? That's the one huge takeaway. There were only 2 times since 2016 when the market got corrected down to the 200-day moving average and then continued lower. Okay? That was right. Keep forgetting this pen. Here in October 2018, and then here, as well, remember, in February 2020. Okay, those are the only two times since 2016 that if price got down to the 200-day moving average, it went lower. And when it did, it went significantly lower. Okay. However, every other time, it found support at that level and moved higher. Okay. So the big question, Mark, is what's going to happen this time? Obviously, we don't know yet. And I go into, again, more detail in the weekly newsletter about what to do if and when it gets to that level and all that. So I'm not going to get into it here. But what we're looking to have happen is we're anticipating, right, that the price is going to come down to that 200-day moving average. And that's where we sort of anticipate some support. And if we get that support, maybe we get back in. We'll see how it goes. So I think that's all I want to talk about that. You can see the relative strength. Relative strength here is decreasing over time. From 2018, right here was the high, and it decreased. Right, it's decreasing as the price is increasing. Not a good thing. That's not a bullish indicator. So we're much more likely that we're at a top, and likely to go lower than we're consolidating and getting ready to go higher. But again, I go into that more in the weekly post. So that's it for kind of the where we are right now on the stocks. So we're going to go into the L fund stuff. So I assume everybody watching this probably got the same email I got from TSP towards the end of August. And it was an email highlighting the L funds. So it was explaining some of the benefits and introducing the expanded 5-year increments of the L fund. It used to be every 10 years. Now it's going to be every 5 years. So the email opens by acknowledging that most of us are not financial experts, right, which is fine. But we still need to make financial decisions that will affect our retirement. Of course we do, right? It then goes into how the L funds will take that burden away from you, okay? So this paragraph, right? Okay, let's face it, planning for retirement can be a chore. Of course it can, right? I'm not going to read this. You guys can read it, but the paragraph is absolutely true. Retirement planning can be a chore, but let's face it, does anyone really think that creating a sizable nest egg for retirement over the course of a 30-year career is as easy as swapping out the batteries in your smoke detector?
Yeah.
I mean, come on.
Yeah. I mean, they tried to make a nice little analogy there with you put your money in the L fund, and it's just like changing your batteries. It's just kind of, once a year you check in on it. And if you think it's that easy, it's not.
Yeah, no, it's not. You can go on autopilot like they want you to do.
Yeah.
And we're going to get into a little bit about why they want you to do that.
You are going to talk about that.
Yeah.
All right.
Yeah.
We got to pull the curtain back.
We're going to pull the curtain back a little bit. Yeah. So the next paragraph of that email talked about how the funds work, right? So the L funds, the L fund is sort of a misnomer. The L funds are a combination. Each L fund is a combination of the C, S, I, F, and G. And the basis of it is risk. So let me not get too sidetracked. How the L funds work. All right, you pick a fund that corresponds to the year in which you expect to retire. Okay, so the historical funds have been like the 2020, 2030, 2040, 2050, right? So you pick a fund in which you expect to retire, and if you buy into the methodology, the idea is you would contribute all of your money into that L fund that's consistent with the year that you want to retire. You would not divide between the individual TSP funds or between the L funds, because that defeats the purpose, right? If you buy into the concept of the L funds, you put all your money into it and you let the fund do its thing. It's completely on autopilot. So whichever fund whichever L fund you pick, that fund is comprised of a certain percentage of all 5 of the individual TSP funds. So the further out L fund you pick, the more exposure you have to the CS&I funds. And then as you progress through your career, the L fund adjusts each quarter to decrease your exposure to the stock funds and allocates more to the GNF funds. So when 30/30, for example, rolls around, and you are in the 30/30, or you're in the L 30/30 fund, your TSP is mostly, almost all of it, is in the GNF fund at that point. And they're converting you into the L income fund. So your risk at that point is almost zero. Your risk in terms of market risk is virtually zero.
Regardless of how the market is doing.
Right. Yeah, we're going to get to that.
Yep.
Yeah. So what they call risk is exposure to stock funds. So your risk at that point is almost zero because you're only pretty much only in the GNF funds. So great. Your risk is basically zero. You're getting ready to walk off the quarter deck for the last time, and
the quarter deck.
Like that? For you Army guys, you probably don't know what that is, but that's okay. Navy guys do. All that without having to lift a finger. Sounds great, but is it effective? Is the L fund really the way to maximize your TSP? So here is a video that we tried. Well, we did. We tried really hard. We spent a lot of time doing it this afternoon, and we're going to show you this 2-minute video. It's only 2 minutes, so definitely it's worth watching. It's going to give you an idea of the concept of the L funds. A couple things to listen for, right? Professionally designed. If you don't have the time, expertise, or interest, and risk. Okay, so those are the 3 things to kind of listen for.
Those are key words to be listening
Keywords to be listening for.
We'll be sitting here watching with you, and when we're done, we'll just come jump right back.
All right, play it away.
Your TSP investment options, the Lifecycle Funds. The TSP has a selection of individual and lifecycle funds that let you diversify your retirement savings. You can choose to invest your TSP dollars in everything from short-term U.S. Treasury securities to index funds comprised of domestic and international stocks. In this video, we'll talk about the professionally designed lifecycle funds, also known as the L funds. If you don't have the time, experience, or interest to manage your TSP retirement savings, consider one of the L funds. Each L fund features a combination of the 5 individual funds, G, F, C, S, and I, that is appropriate for your time horizon or the future date at which you plan to start withdrawing the money in your TSP account. Here's how it works. The L funds assume that the farther you are away from needing your money, the more you are able to tolerate risk. Therefore, they give you the opportunity to enjoy the potentially higher returns associated with investing in the stock markets. But the funds continually adjust, so as the time nears for you to withdraw your money, it is more conservatively invested. That way, you're not exposing your entire savings to unexpected market changes right when you need the income. As with all investments, there are risks. The L funds carry the same risks that are associated with all of the underlying individual TSP funds. Watch our other fund videos for more information. To find out which L fund might be right for you, or to learn more about the other TSP funds, watch our entire series of fund videos, or visit tsp.gov to review our fund information sheets.
And we're back.
All right. Okay. Hopefully you guys didn't snooze through that video.
It's fast enough.
Yeah. There's some good stuff in there. It gives you an overview of the L funds, and hopefully you guys listen to the 3 points that we pointed out, right? So what we're going to talk about for the rest of this part of the L funds really is risk, because that's the basis of the difference between how the L funds do it and how we do it. All right. Run the slide. Okay. All right. So risk. So the L fund is based on your personal risk in terms of your age or proximity to retirement. So from their perspective, and it's the conventional wisdom, right? What we're doing is an outlier. So they're doing the conventional wisdom. they're basing their professional management of the L fund on your personal risk tolerance, circumstances, age, proximity to retirement, future goals, whatever. It's the same thing the financial planning industry uses to put you in which bucket you're going to be into if you use a financial planner. That's as opposed to market risk. Okay, market risk, as we've talked about a lot, is the risk of loss that you would realize in an account because the price of the stock goes up and down that you own, right? It's the risk of potential gains because you're in the G&F fund versus the risk of loss if you're in the stock funds, all right? That's market risk. So the L fund, the personal risk model for the L fund, right? Again, conventional wisdom says to be in the stock funds when you're just starting out in your career and decrease exposure to the stock funds as you get closer to retirement, right? That was the whole idea of the circular chart or graph, whatever that they did on that video. It's decreasing your exposure to stocks as you get further along in your career, right? This is because you don't want to risk losing money in your account as you get close to retirement. Seems to make intuitive sense, right? And that's what the retail financial services industry tells us. That is magical thinking, okay? Why do I say the L fund is magical thinking? It's based on managing risk throughout your career and decreasing risk as you get closer to retirement, right? Wrong.
Sounds good.
Yeah, no, wrong. The term risk that's used by the L funds and virtually all of the retail investment industry is based on you, the individual. The reality is that the market doesn't care about you. And I know you keep I know that's one of your favorite quotes that I do. The market doesn't care about you as an individual. It doesn't care about your age, proximity to retirement, future goals and plans. The market does what it does, right? Regardless of your personal circumstances. So then why are the lifecycle funds, which is what they're called in the industry, it's not just a TSP thing, why are the lifecycle funds the industry standard? The reason is because the plan provider, whether it's the provider for the TSP or Fidelity or Schwab or any other provider of a 401k plan, they make money when they do the reallocations, regardless of which way the market goes. So BlackRock is the contractor that provides the TSP to the federal government. BlackRock also happens to be the largest financial services company in the world.
Imagine that.
Yeah. They are in the business of making money for who?
For them.
For them. Not for you. They don't mind if you make money, but they're in the business of making money for them. There are no employees at BlackRock or at TSP, for that matter, whose job is to maximize your TSP account. When they say they're professionally managing it, they're not professionally managing it. The L funds reallocate every quarter, regardless of what the market's doing. It's an algorithm. That's their version of professionally designed, right? That was one of the buzzwords, professionally designed. That's how they make it so you don't have to lift a finger or clutter your to-do list, right? It's magical thinking.
Yeah. It's just going to magically make money for you.
Yeah. No.
It's not going to happen.
I mean, if the market always goes up, it goes up. But is it maximizing your TSP?
No.
No. All right. So what's the alternative? So the alternative approach is what we do here at Grow My TSP. It's actual management. Like we said, the market doesn't care about you as an individual. It does what it does. So to maximize your TSP account over time, you have to be on the right side of the trend. You have to be in the stock funds when the market's going up, and you have to manage risk when the market's trending down. So when we at GMTSP, when we refer to risk, we're talking about market risk, the risk of not getting gains when the market's going up, right? Or realizing losses in the market when it's going down. So this has nothing to do with you, your age, proximity to retirement, your goals, or whatever.
Because we get that question a lot. Like, well, where should I be if I'm, close to retirement, or hey, I'm mid-career, and we basically have to go back and explain this, again and again, which is understandable because it's not the normal thinking,
right.
And it really doesn't matter where you're at in your career if your goal is to maximize your account.
Yes.
Those two don't go together.
Right. We use technical analysis, right, to keep emotion out of reallocation decisions by thinking 3 steps ahead on each decision, right? When we make a reallocation decision, we know in advance what we'll do if the market goes against us, and this both quantifies and limits our downside risk, right? So here's an example. The C-Fund chart from the beginning of the show it's a really good example. The chart that we have up right now is obviously it's the same chart, but it's daily. It's not weekly. And hold on, let me get my thoughts here. So the C-Fund chart from the beginning of the show, good example. We know the market risk is high where we are right now. Let me see my pen here. Nope.
That pesky little pen is being magical right now.
So right there, that was the highest level of risk for the market. And if you were a subscriber back then, we got out. We got halfway out of the market right there, and we got the rest of the way out right there at 3,300. We're 100% G fund right now. We know the market risk is high right now, especially since all the major indexes are below their 50-day moving average line. So regardless of your personal risk profile, the market risk is what it is. Once price falls to the 200-day moving average, right here.
Just be the red line.
Right, market risk is going to decrease dramatically. So if you reallocate, for example, from the G fund to the C fund at that 200-day moving average, your potential gain is huge, right? Because we already know that we had support at the 200-day moving average most of the time. We had 2 times where we did not get support there. So the odds right here are pretty high that we get support. But if we don't, it's no big deal. If the market goes against us and continues lower, you just get out and you accept a small loss.
Right. As opposed to, I'm not sure if you're going to get into this, because this is the other part of the story when we talk about the PIP, right? And I know you're going to get into that in the next slide about the PIP, but it's real key to see I think it's key to see on this chart where absolutely, if you got that huge V there that we just did, right? The huge drop.
Yep.
And most people's conventional wisdom, the conventional argument would be, I wrote it all the way down. I wrote it all the way back up. I didn't realize any losses.
Right.
And I'm back up. I got back everything that I lost. Well, that's partially true. The difference is if you get out, even if you take a little loss and you get out and sit it out, right?
Right.
When you get to the bottom and then jump back in, you get all those gains.
Right.
The people that wrote it out didn't get those gains. They only got the gain from the top of those 2 on the chart, right?
Right.
Yeah.
And it's funny because as we sit here talking about it, I can tell you know it now well enough to see it in your mind the gains.
It took a while, and that's why I kind of I pointed out, because Jerry is obviously very very knowledgeable in the technical analysis, and I try to be the kind of the dumb guy on the side. Okay. But it is, for the average person to get two things I think if you take away from this entire show, this entire discussion, is the market does not care about you. It's going to do what it's going to do. So if that's the case, then we need to be paying attention to the market and managing our risk based on the market, not on our personal circumstances. Whether I'm getting ready to retire, my kid's going to college, I want to buy a new car. Like, all those things matter. It's not that they don't matter. It's just they don't matter to the market. And so if my goal is to maximize my TSP account or my 401k or anything that's similar to this, right, the same situation, you want to be out when you know there's going to be a huge drop, and then you want to get back in as close to the bottom as you can, and you're going to realize so much more of a gain than you would if you just rode it out. Because the same person, correct me if I'm wrong here, Jerry, a person could have the same PIP. Two people could have the same PIP, right? The performance, right? Yep. Let's say both people had 20% PIP, but one only realized a very small amount of gains, and another one could realize huge gains. Right?
Yeah. The PIP is important. It's a snapshot of where you are.
But it's not the whole story.
It's not the whole story. We're going to have to do another whole piece on that because we're not going to get into that on the next slide.
All right.
It's a rabbit
hole. It's
not all that complicated, but it's a rabbit hole, and it's worth doing another show about. So how can we be so sure that technical analysis, right, the managed approach that we do here works infinitely better than the set it and forget it sort of way that the L funds want you to do it? The graphic here is our results over the past 12 months versus the L fund. It's kind of a no-brainer, right? Especially for people that are at or near retirement. So if you are just starting out in your career, it's 2020 and you got 30 years to go in your career, and you're in the L2050 fund. Why is this? Okay. Nope. Damn it. Nope. Okay.
Pen
problems. All right. If you're in the why isn't this working? Pen. You're in the L2050 fund.
There we go.
Okay. In the past year, the L2050 fund did 12 or 13%. Our PIP for the last 12 months that ended in end of August was 20.23%. So if you are just beginning your career in the L2050 fund, we still crushed where you would have been.
Right. And that's the most aggressive combination of allocations through the funds, right?
The stock funds.
Yeah, and I like the L fund. I like making the showing this graph, because what we do here at Grow My Thrift Savings Plan, you could think of it as a type of fund, right? We are allocating. We are changing the allocations of the 5 different,
right?
Exactly the same thing that the L fund is doing. It's just they're doing it on autopilot.
Yes.
Or we're doing it based on market risk.
Yes. That's exactly right. So what they do is based on risk, and how they define risk is you and your personal circumstances.
Right.
We're doing a managed fund based on risk as how we define it as market risk. So yeah, it's very similar. And I really wish the L fund or the TSP would give us an option of a true managed fund, as opposed to the L funds, which are not managed. They're on autopilot. As they've told you, they're on autopilot. So that's the best case. If you're in the most aggressive L fund, 2050.
Which is generally what you would be in if you joined the government or the military right now.
Right now, yeah.
That's what they start you off in, right?
Right.
The L fund am I correct? Because they didn't do this for us, obviously.
No.
They didn't have it.
This changed a couple years ago. Now
it just auto defaults to the L fund. You got to change it, basically. So you come in, they want you to have the L funds for the reasons why we described. They want you to be on autopilot.
Yeah.
They really don't want you to manage it the way we're doing it, because there's more movement, there's more changes, and what is that called? Fees, and more work, and that's kind of how it plays out.
And another way to look at it is it's not like they're trying to. It's not devious. They're not trying to hurt you, right?
No, this is the best they can come up with.
Yes, it's the best they can come up with. And of course, if you've been in government long enough to know, you know that the government doesn't come up with it. They contract out
Yeah.
a vehicle, and BlackRock, the largest financial services firm in the world, is happy to come into the government and say, we have a solution for you. And it should be no surprise to anyone that it's going to be in their best interest, not in the best interest of the TSP.
Yeah, and I don't think we want to say that they're absolutely right. We'll say it again, that we don't think they're doing anything wrong or that their intent is bad. This is the best they can do, because they're not going to put a team of people in a room and do technical analysis for all of us.
No, it would cost you a fortune.
And give us alerts and do all this stuff. I mean, every once in a while, someone will kind of ask us, like, they think the service that we provide, the monthly service, which now is at $20 a month and $200 a year. That's a lot, because we know people that charge close to $1,000 a month to do much less, and you couldn't even afford to do it if you had asked BlackRock to do it for you. Like it's not even a possibility. And you'd have to have millions already, right? That's kind of how they play the game. Is if you want to get into their world, you got to have 5 million.
You have
assets,
a lot of money.
10 million. Sometimes some of these managers, it's like 50 million.
Yeah.
And that's not our world, right? Not as a government employee or a military service member. So anyway, hopefully we're giving you guys some sort of insight as to how the game is played, and you can decide to play it any way you want to. Jerry says it all the time. This isn't the only way, but we think that it's the way to maximize your TSP account, which all of us have to. If you're watching this show, you've probably understand that this is probably one of the most important pieces of your retirement, because you're going to have the annuity. That's a done deal.
Yep.
But that ain't enough to live off of. And I'm here I can tell you it's not enough to live off of. So if you don't have your TSP to subsidize that, or to be the big part, it's going to hurt when you're not going to be able to fully retire the way you want to.
Right. And so the 2050 fund, those are for the guys that are just starting out. Great. We clearly beat them by a pretty wide margin. Most people that are watching the show are more like in here, 2030 and 20 income. And I mean, we almost double them.
Yeah, we completely crush anything remotely close to mid-career towards the end of the career. Yeah.
So
and it's another thing that you say that a lot of that it's very against the conventional wisdom, which is it's almost just as much or more important once you retire to actively manage your retirement fund, because sure, you could just throw it in the G or roll it over into a money market, whatever it is, and it is what it is. It's never going to grow if you're happy with the bucket you have.
That's buying an annuity.
Right. That's basically what you just did. Yeah, and you're just going to ride it out until the end or do whatever you're going to do. But if you want it to keep growing, why wouldn't you keep managing? Now, it also goes back to the risk factor, where you start to take in your personal risk, and you say, there's a couple of good examples in our Facebook group lately where people follow us very closely, but also got into the G faster than we did, 100% in. Mm-hmm. Why? Because they're in retirement, and they're like, yeah, you know what? I hear what Jerry's saying, and I'm out completely. Yep. Where Jerry's like, I got a little bit more, because, this is based on Jerry's TSP.
My personal risk tolerance.
Exactly. Yep. And we decide to follow that, or we might, tweak it. And that's when you're really, using this service to the best of its ability. And then there's the majority of people that are members of our site that do want to kind of set it and forget it. But all we really do is 2 or 3 times a month, you got to make a change. And that's not that much.
No.
That's not a lot of work, because there was one person I think recently that said it had a post. It's like, you guys did all that work and you still got 20%. It was like, It's only 2 moves. Like, it's not a lot of work. Well, you get an alert on your phone, you go to TSP, you push a button, and it's done.
It's not a lot of work for the subscriber to the site.
Right. Now
it's a lot of work for us.
Yeah. But that's okay. That's what we're here for.
It is fine. And another the follow on. Yeah, it's great. It's I'd much rather do this than my day job.
Yeah.
The next comment on that same Facebook post was somebody acknowledging that the drawdown.
Yeah, which is the other part of the story.
Yeah, and I don't want to go down the rabbit hole, but the drawdown, from February to the end of March, if you were in the C fund, say you were 100% in the C fund,
you just wrote it down.
You wrote down 34% of the value of your account. We wrote down 0. Right.
And jumped back in.
And got back in. Now, we didn't get in at the bottom and stay in all the way up, and because if we had, our returns would have been like out here somewhere. Right? Yeah. We didn't do that. which is fine. We're managing the risk.
Right.
You manage the risk on the way down. You manage the risk on the way up. But I think the results out here are pretty good. And just so you guys know,
go ahead.
Yeah, I mean, just so you guys know, I'm within 12 months of retirement myself.
Yeah.
So, and I'm putting out the alert at the same time that I'm moving my personal money in TSP. So it's, I'm in this bucket, right? I'm in this bucket right here, and I'm getting these returns here. And I would tell my 20-year-old kids the same thing. They manage their money the same way.
Yep, exactly. And just because we get this question every once in a while since we brought it up, I'm retired, Jerry is about to retire, and we're still going to manage. Jerry will still be partially in the TSP, even though we do generally recommend to roll over a decent portion into a more flexible IRA. That's something that we'll talk about more as we go, because we're actually looking at finding ways to kind of provide that as a service also, using the same management technique, managing risk to the market. But the key is that for the next 20, 30 years, we're still going to be managing this exactly the same way. So there's no worry. Every once in a while, folks kind of catch on that, you're retiring. Does that mean you're going to do it different? Nope. It's still going to be exactly the same. Same. Because it's easy to do because the market doesn't care that Jerry retired.
Exactly right.
The market doesn't care.
It's going to be the same.
Yeah. The whole thing works exactly the same, whether we just started yesterday or we've been retired for 10 years.
I mean, so
the market doesn't care.
It doesn't care. So, and we talked about how I don't think on recently we've talked about this, but we since COVID came around, I had some opportunities, some time to do coaching calls. And if anybody wants to do a coaching call because you have personal circumstances you want to talk through and how best to manage your TSP with respect to that, shoot us an email and we'll get set up. There are things that you will do in retirement that you will not do when you're an employee. So if you have a bunch of money in TSP, you may want to take some of it out and buy an investment property, right? There's a lot of things you can do when you're retired that you can't do when you're an employee.
Yep.
And so it's very specific to the individual. And we can certainly talk through that if
and that speaks to the whole idea of how much you might leave in the TSP once
Right.
you retire versus roll over to an IRA.
Right.
It really just depends on what you're going to do.
Right.
Yeah. And
so it's not one size fits all at the point of retirement. But in terms of what you do decide to keep in your TSP when you retire, it's the same. Whether you're just starting your career or in retirement, the piece that you keep in TSP is
you're going to manage exactly the same.
Yeah.
Outstanding. Well, hopefully we got
let me
under the hood there
where
for
I am real quick on this thing. I was already there, right? I already did the slide. No, I didn't. So if you were sorry, I lost my train of thought.
I took Jerry off of his notes. We were on the L Fund graph, the PIP graph.
Yeah, our PIP. So now we're on the C Fund 3-year daily. So if you were a member back in February, you reallocate to the GNF funds. Actually, I was about 50-50 GNF back on, it was the 21st, which was, golly.
Pen is not cooperating today. Cooperating.
Okay. That's not what I want. Right there. If you were a member of the site back in February, you reallocated to the GNF funds 2 days before the 34% collapse in the C fund, which was right here. Okay? Which means your risk-adjusted returns are like off the charts, right? Pardon the pun. Okay? And that's with only the 5 funds that we have to work with, right? In the current correction, okay, which we are right here, we moved to 55% G back on August 30th, and then to 100% G about a week ago at 3,300 on the S&P 500. So it was like right there. Okay, that's managing risk. That's what we talk about when we talk about managing risk that's active management, as opposed to the set it and forget it thing that the elf funds want you to do. Okay, like I said, it was going to be a little bit disjointed. That's fine. So that's our methodology and our results versus the S fund or the elf fund. Sorry, it's not easy, right? If you're on board with us, you will have to learn the basics, right? You got to learn how to make decisions and take responsibility for your TSP account growth. It's the exact opposite of what the L fund wants you to do, but it's obviously worth it, right? What we're doing is based on reality. It's not magical thinking.
This is the real world. The market goes up and down. You want to be in and out of it. You don't want to just put it in the L fund and forget about it. And if you disagree with that, it's probably best that you don't watch this show.
Yeah, again, there are plenty of ways to play the game. There are lots of guys out there that are happy to, for a fee, to manage your money.
For large fees.
Yeah.
All right, is that all you got for us this week?
That is all I got this week, my friend.
Well, I think it was plenty. Hope you guys enjoyed the L Fund breakdown. If you have any questions, throw them in the Facebook posts. So this always goes out on our Facebook page first. Most of you that have been watching see that. We do that because the Facebook page actually, if you set it for that, it will alert you that it's live and it's going, and then it's kind of more interactive. And then about 15 to 30 minutes later, depending on how the internet's working, it goes out on YouTube and then at the same time goes into the Facebook group. So that way you can go back and watch it if for some reason you're not able to watch it live. But the first place that you can see it is at 6:30 p.m. on the Facebook page, Grow My TSP, Grow My Thrift Savings Plan Facebook page. All right, guys, that's all we got for this week.
Awesome.
Let's play some music.
Have a great week. Let's roll.
All right, man. Let's go have some chili.
Let's do it.